Hi, everybody. Welcome to the Long-Term Investor. Today, joining me is Gerard O'Reilly, Co-Chief Executive Officer and Chief Investment Officer of Dimensional Fund Advisors. Gerard joined Dimensional in 2004, but was named co-CEO in 2017. And he, along with co-CEO Dave Butler, guides the firm's vision and strategy through daily oversight of the company's people and processes. Since joining the firm, Gerard has been instrumental in the evolution of Dimensional's systematic approach to creating and implementing investment solutions. He was formerly head of research, managing the firm's rigorous scientific approach to interpreting, testing, and applying research in portfolios. He is a member of the firm's investment research committee, which reviews potential investment strategy enhancements, and a member of the investment committee, which oversees portfolio and account management. Prior to joining Dimensional, Gerard obtained his PhD in aeronautics from the California Institute of Technology. He holds a Master's of Science degree in high performance computing from Trinity College, Dublin, in his native country of Ireland, where he also received a first-class honors degree in theoretical physics and was the recipient of the Foundation Scholarship. Gerard, thank you so much for joining me. It's an honor to have you. Your background is very decorated, as you can tell as I'm stumbling through reading your introduction, but it is a true pleasure to have you with me.
Peter, thanks for having me on the show. Really appreciate it. And thanks for that very warm welcome. It's rare that I hear all of those things called out. It makes me a bit embarrassed.
Well, I have known you and been working with you for quite some time. And I can assure you, I feel like we could have talked for 20 minutes about your background. You are a wonderful person. And I'm really looking forward to having you share some of your perspective with listeners, particularly on things, maybe we could start with the things that they're seeing in the media. For example, a headline that's coming up quite frequently these days, and granted it comes up almost once a year, is that market valuations are particularly high. The headline you typically see is overvalued. And you, like I said, you see it almost every year. But I was hoping you could share some perspectives based on some of the work that you do as it pertains to market valuations today.
Yeah, we're seeing quite a few headlines to that effect right now, Peter. And you're right. Whenever you've had a good run of market performance, people say, well, we've hit a new high. How high can it go? And we've done plenty of work on this topic over the years, looking at various different ways to say, can we say something about future returns of markets, giving their recent returns, our overall valuation metrics. So let me put it a little bit in context, Peter. When the headlines are talking about these numbers, what numbers are they talking about? There's a few that are often mentioned, and one is things like price to earnings ratios of the overall market. So what aggregate price to earnings ratios look like. And when you look over the long pull, the past 60 years or so, the average has been around 15 for the US market, give or take. And right now it's in the mid to high 20s. When you look at something else that people talk about, like CAPE ratios, you often hear of that ratio. And that one, you can go back 100 years to look at that. And the average has been, between 50 and 20. And that hit about 30 a couple of years ago. And so the question that we ask ourselves at Dimensional as well, given that ratio, can it tell us something about future returns on the equity market? And the answer is a little bit yes, but it's not helpful from an investment perspective. So what do I mean by that? What you find is that there is some predictability of future 10-year equity returns based on current valuation ratios. And that kind of makes some sense, because what might make prices go up? Well, prices can go up because expected future cash flows are higher. Our prices can go up because discount rates go down, our expected returns go down. So you would expect there to be some information in those types of ratios about future returns. So I say that's where some of this comes from, is when you have a little bit of predictability, the media tends to jump all over that, regardless of if it's useful predictability. So why do I say it's not that useful? It's not that useful, Peter, because when you look at the amount of predictability you have at the 10-year mark, it's so slim relative to what you would need to make asset allocation decisions between stocks and bonds on any given year that it's not really that helpful an input. And so if you look back at the past 100 years and look at the predictability, it basically gives you a 1 in 5 chance of being right on any given year about whether stocks will outperform bonds or vice versa. And that's not all that helpful. So that type of a of a ratio is not all that helpful. So our view is prices move around. Why do they move around? So that expected returns of stocks can meet what people require those returns to be on expectation. And stocks, I think most people require higher expected returns to invest in bonds. And expected returns on stocks, that premium excess return over bonds, in our view, is always positive. There's no evidence to suggest that ever goes negative. So while it might be higher and lower from time to time, you can't tell with enough precision to use it as part of your overall investment approach.
Well, that's very interesting. And one thing that I'm going to latch on there too is because investing is often a probabilistic endeavor, even if the probability is a little higher that there's going to be below average returns over the next 10 years, like you said, there's not enough precision there to make portfolio changes. However, I do think it is helpful when people at least get in the right mindset to recognize, well, maybe if we're up 20% this year, maybe that's not a reasonable expectation. And just setting expectations sometimes lets clients stay the course. The other thing is Dimensional has a long history of implementing value strategies. And it's my understanding when you look at the market valuations, if you are buying the whole market, if you're buying an index fund, well, that is one thing, but there is a bit of a difference between growth valuations and value valuations. Is that correct?
Yeah, you're spot on there, Peter. And I would just echo the point that you made around, if you're up 20%, 20% is certainly not the expectation given the long run returns. But the long run average might be 10%, but rarely is the market up just 10%. Usually it's up a lot more or down or up a lot less. You rarely hit the long run average. And you're also right in terms of when you look at those valuations. So I'll switch now a little bit to price to book ratios and use some Fama French data as an example to give us a perspective on value versus growth. And when you look at the long pull kind of difference in aggregate price to book ratios between growth stocks and value stocks, it's been in the 3 to 4 neighborhood. Right now, it's in the 9 to 10 neighborhood. And you say, okay, well, how did you get there? Well, value stocks are kind of along their long run valuation, the 1 to 2 neighborhood of aggregate price to book ratios, where growth stocks are in the kind of the 11 to 12 neighborhood of valuations. So certainly the higher valuations that you're seeing in the marketplace right now, a good chunk of that can be attributed to the valuations on growth stocks. And you say, how did growth stocks get to where they are today? Well, they had some exceptionally good returns over the past decade or so. And that's led them to have very high price to earnings ratios, very high price to book ratios, whereas value stocks have actually had returns more in line with their historical average over the past decade or so. And it's kept their price to book ratios kind of in line with their long pull averages. So I think that's an important point. And I imagine many of your listeners, given your focus on value investing, Peter, are familiar with some of the relative returns to value. And certainly we've had a fantastic past 12 to 18 months on the returns of value stocks versus growth. You look at something like Fama French indices again, for the 12 months ending June of this year, 2021, there was almost a 30% outperformance. And I think the question and the spirit of what you raised, if you had a 30% just gone by, should you expect 30% premium next year? Well, the answer is no, but you also should not expect a negative premium. I think that's important to keep in mind, because when you look at periods after you've had a very strong value premium, the average over the next 12 months is certainly not negative. The average tends to be positive over the next 12 months. So there's no reason to expect that we can't have another fantastic outcome for value versus growth over the next 12, 24 months and 10 years and beyond, just because we've had a fantastic outcome over the past 12 to 18 months.
Well, as a value investor myself, I sure hope that's true. And I think well, being in such an academic mindset yourself, that financial theory tends to work out really well in the long term. You just have to give yourself that long-term period to really realize it. And as we talk about valuations and giving people context to how a headline such as markets are overvalued or valuations are all-time highs, it's important for people to remember that what is that in the context of your portfolio? And as you pointed out, it would be very unwise to be making portfolio changes because the certainty of how that's going to impact future returns is low. But having your expectations there and looking at your financial plan, thinking of something you can control, that's maybe a better place to focus. But another place I think where people don't think of it as much of valuations in the traditional sense, but another hot topic at the moment are interest rates. Interest rates are low. To me, interest rates are almost the cost of safety in some sense. And I think with inflation readings higher these days, there are a few more headlines pointing to low interest rates and what are people going to be able to get out of their fixed income portfolio. Maybe you could share your perspective on that general trend and topic line.
Yeah, interest rates certainly are low these days, but it depends on what interest rate you're pointing to as to how low they are. So people often obsess over the Fed funds rate and what will the Fed funds rate do and where will it go to and all of those types of things. And a pretty simple way to kind of put it in your mind about how important that rate is in kind of comparison to other interest rates that are important out there and how they drive the overall returns. If you look at the US, let's just take the US as an example. In the US, you have different duration buckets. So what does that mean? 0 to 5 years, 5 to 10 years, 10 to 15 years, and so on and so forth at the 30 years. And a very coarse kind of breakup of the US, set of maturities might be in 6 buckets, 5 years apiece. Then you say, okay, but there's more than just the US market. Let's look at developed markets. There's about 15 different currencies of issuance. We have British pounds, you have euros, you have Swiss francs, you have a whole bunch of different currencies of issuance. And each one of those have their own yield curve. So that's 15 times 6. And how many credit qualities are there? Oh, well, if you go from governments all the way down to double Bs, that's another 6. So now you're talking about over 500 interest rates that will drive the return of a well-diversified portfolio. And I think that's important to keep in mind. The Fed funds rate is important, there's no question. But you have to have a broader context and a broader vision of what all of the interest rates are that might impact your portfolio. And you can look back in time historically at some periods when the Fed funds rate have been low. So if you go from 2009 to 2018, a 10-year period, where the Fed funds rate were also very, very low for most of that time period, close to zero. And you look at the return of a globally diversified basket of bonds, it's between 3.5% and 4%. A more recent example is something like a global core plus, which is kind of, you can think about global bonds all the way down to double B, governments and corporates and so on, all the way down to double B. And if you look at the 6 quarters, the most recent 6 quarters, so what's the first quarter there is the second quarter of 2020. And what do we know that happened to the Fed's funds rate in the first quarter? It went down, and it went down by quite a bit. So now we're talking about 6 quarters where the Fed funds rate has been low. And that strategy has pulled over 11% in terms of a return, cumulative return over those 6 quarters. So again, a low interest rate environment, but you can have good returns on globally diversified baskets of bonds that are holding governments, corporates, securitized, and all of those types of things. So I think that the item that I tell people to keep in mind is that there are many different interest rates out there, and they're not all low at the same time. They don't all move together with each other, and they all give you information about where the higher expected returns are. And you can use them if you have a systematic approach to increase your expected return in a prudent manner, regardless of if interest rates are low or high. So it's always a good time for systematic fixed income. But if you're looking for a bit more expected return now is an even better time for systematic fixed income.
You have some wonderful materials on your investor-facing website that I will be sure to link to in the show notes. For those of you listening, as always, you can go to thelongterminvestor.com. And you also have some interesting things on inflation, of which I did a whole episode on. However, I'd love to just have you chime in on inflation, particularly as it's hitting the highest levels it's hit in quite some time. Some say it's transitory. Some are now questioning whether that's true. But from an investment perspective, how are you thinking about inflation these days?
Yeah, this is another one that's certainly on people's minds. In particular, as you prepare for Thanksgiving, and the turkey is 20% more expensive than it was last Thanksgiving, and that's going to be playing on people's minds. Certainly, we've had high inflation over the course of this year. You can look to markets and try to understand what markets are saying about the next 1, 2, 3, 4, 5, and beyond years. And that's something called break-even inflation, which is effectively the difference in yields between a real bond or an inflation-protected bond and a nominal bond. And it kind of tells you if inflation is X, well, then the return that you're going to get out of the real bond or the nominal bond is going to be equivalent. And right now, that's about 3% at the 5-year mark. So that's not too high relative to the long pull average. It's a little bit higher than the long pull average, but not too high. Now, I think that investors shouldn't spend too much time speculating about what inflation might be, because regardless of if it's a market or some other process, when inflation comes, it often comes in an unexpected fashion, and there's no good way to predict the unexpected. You can't predict the unexpected, but you can plan for it. And there's two ways that you can plan for it. One is you can try to outpace it, and the second is that you can try to hedge it. So you can look for assets that historically have had positive real returns, and have they had those real returns when inflation has been high or been low? And the answer is there's many such assets. Global stocks, global bonds have had positive real returns, and they've had on average positive returns in years when inflation has been high and when it's been low. So that's one way to outpace it. If you're outpacing it, be prepared that in certain years you will underperform it. And if you can't handle that, then you may want to hedge it for a portion of your assets that you need to consume over a period of time. And there's lots of good ways to hedge it. You can buy inflation protected bonds. You can buy inflation swaps along with corporate bonds, so you get a bit of a higher expected return. So there's lots of good ways to hedge inflation. Our view is that if you are hedging inflation with inflation protected bonds, make sure you take into account what the yield curve is telling you. I'll give you an example. We have an inflation protected strategy here, Peter. You're pretty familiar with it. It's just past its 15-year anniversary a couple of months ago. And over the 15-year period, it's done a couple of things. One, it's had one issuer eligible, the US government, Treasury from the US government, just like the benchmark. It's had a very similar duration to the benchmark, which implies very similar volatility, but it's outperformed by 15 basis points net of fees and expenses versus the same issuer, very similar duration. And how has this done that? Because we take into account the information from the yield curve to focus on the belly of the yield curve, as we call it here. And I think that's something that investors should keep in mind. Not all inflation protected strategies are created equal. And so make sure that you choose one that works for your needs.
That actually introduces a wonderful segue, because in my role in designing portfolios for the end client, there is a lot of research where we try to find research that we believe in theory. And then there's the actual implementation in practice and going out to find products that align with that research. I think one of the interesting things about Dimensional is the rigor involved with the research and decision-making process in the implementation of different exposures and strategies within a fund, like you're talking about now with paying attention to certain parts of the curve and the trading strategy in order to earn extra return, both in implementation and in design. And so I was hoping you could maybe spend a little time talking about how you think about the end investor and when you're designing different products, for example, or even deciding to add exposures to different products. For example, I know as factor investors, two very prominently focused on factors are profitability and momentum. Some people will call profitability quality, and they all have different definitions. But for our basic listener, let's stick with it and keep it simple. Profitability and momentum, things that you can see in the research, and maybe talk a little bit about what the research process looks like to say, okay, this is something that might be a driver of returns, but also the process in which perhaps you say, even if it's a driver of returns, can you capture it? Any sort of insights you can provide there would be wonderful.
I will do my best, Peter, and settle in. We'll get into something that I enjoy a lot. I think that it would be helpful for your listeners, Peter, to give a little bit of background on the firm as well, so it can put how we approach research into context. So, as you well know, Dimensional was founded in 1981. And I think that one of the interesting things I like to point out about the founding of the firm is that it had very strong connections to academia from day one. And so it had very strong connections to the University of Chicago. And of course, we know that the University of Chicago has over 30 Nobel Prize winners in economics, more than any other institution in the world. So that pedigree of academia is long ingrained in Dimensional's approach. In 81, we had a small cap strategy, a micro cap strategy. We added fixed income a little later. But there's three things that I would point out that are true at the firm's founding and true today. One is that prices are forward-looking and predictions of the future. And what I mean by prices are market prices, the price of stocks, the price of bonds, the price of options, things that are traded in the marketplace are forward-looking and predictions of the future. And our job as managers is to understand how do you extract that information from those prices to either increase expected returns or manage risk. The second important item, and this permeates its way into how we do the research, is optionality has value, and we should capture it on behalf of our investors. So that means that if you have a rigid approach, an approach that can be flexible, the approach that can be flexible is likely to yield better outcomes for investors. And that will be important when we get to the momentum topic, Peter. And the third thing that is true then and is true now is that we think systematic is the right way to go, because that allows folks like yourself, financial professionals like yourself, to understand well what our investment process is, know what to expect from it, know how to monitor us, and know how to keep us accountable and make sure that we're doing what we said we would do. And I think that's very, very important. So those are things that, the firm has held true for a very long period of time. And now we manage assets all over the world, equities and fixed incomes, just a lot of different asset categories. So that takes us to the research aspect, and the academic connection, I think, is important, because at Dimensional, we have a viewpoint here that you're going to do far better if you embrace the right answer rather than defend the wrong one, just because the wrong one was yours to begin with. So whenever you find a better way to do something, figure out how to use that better piece of information to make your clients' lives better. And that's what we hold to very dearly here at Dimensional. So we have connections with lots of different academics across great institutions. So Chicago, Stanford, Yale, MIT, Harvard, University of Rochester. That's just a short list of some of the academics that we work with or have relationships with. And then we have over 100 people on our research team here internally, and with many PhDs in economics and finance and statistics and engineering and computer science, all sorts of things that help us then take that academic kind of knowledge and insight and how do we bring it to real world portfolios. And generally what we do, Peter, is that we'll kind of assess an academic paper. We see, does it make sense? Is this something we should expect to see in the data? And then we subject it to a whole battery of tests where we test it out of sample, we test it in our own data sets, we shake up the experiment a little bit to really get a deep understanding of the data, but also because there's going to be a strong bias towards publishing the results that were positive in the academic community and not all the results and all the experiments that didn't work out. So we want to understand that well. Once we have done that, then we form a view on the research. So that's kind of a little bit of background that we can take into profitability and momentum. And the profitability and momentum are two interesting examples. One, because profitability is what you'd expect to see in the data. Momentum, you would not expect to see in the data, but we end up using both, but in very different ways. So,
Gerard, just for our listeners' benefit, maybe we could give them really basic definitions of each.
Okay, so profitability is basically how is your income scaled by some other measure of firm value. We actually use operating income, but you can think of anything from the income statement. So you can start at the revenue and work your whole way down to income, and then you can scale it by assets or book value. Generally, the more formal definition is earnings on book is the more formal definition. We use operating profitability, so operating earnings on book value. So that's profitability. Momentum is your return relative to other stocks that are similar to yourself. So let's take all the stocks in the US as an example, sort them on their return over the past 12 months as an example. And those that have had the highest returns, we define as upward momentum. Those with the lowest returns in downward momentum. So it's a relative ranking of recent returns. And the empirical evidence is that stocks with high profitability have outperformed stocks with low profitability, and stocks that are in upward momentum have outperformed stocks that are in low momentum or downward momentum post them becoming up or down momentum, and post them becoming high or low profitability. So it's a forward looking. You sort today and you look out over the next few months or years. And so the question is, why would we expect to see profitability in the data? Well, when you think about an investment in a stock, you're basically becoming a residual owner of the firm. You have a claim, a residual claim on those cash flows. The higher the cash flows, the higher your expected payoff. The lower the price, the higher the discount that has been applied. So again, the higher the expected payoff. So you would expect that in a simple valuation framework of the world, that lower price, higher expected cash flows equals higher expected returns. Profitability is one side of that coin, higher expected cash flows. And so you would expect it to be related to returns. It's a simple discount rate effect. And we think there are differences in expected returns across stocks, and therefore the expected cash flows or the price that you're willing to pay have to be related to the differences in returns that people demand to hold different stocks. Momentum, you wouldn't necessarily expect it there, Peter, because would you expect a stock that has gone up, so its valuation ratios have increased, to continue to go up? Not necessarily, right? That doesn't seem as intuitive that you would expect that. But what you see in the data, Peter, is when you look across many different countries, many different time periods, you see both of those premiums and effects in the data, but there's one big difference between them. When you look at profitability, a firm remains high profitability generally for years. So if you buy a firm with high profitability, it tends to stay higher profitability than other firms for 1, 2, 3, 4 years. When you look at momentum, a firm tends to stay in up momentum for only a few months. And that difference is important because it tells you about, while these are two observations in the data, you want to implement them in very different ways. So,
well, and I appreciate that background. And I chose profitability and momentum intentionally, knowing that you implement them differently where, and you should correct me if I'm wrong, but because of especially that last statement you made, if you expect profitability and its benefit to persist for years, there's arguably more benefit to explicitly targeting it, whereas perhaps you're using momentum to inform your trading decisions, but maybe not emphasizing the explicit target as much as others might. Does that sound fair?
Yeah, you got it. It's exactly right.
Certainly we've had our fair share of conversations about it. And, I think what's interesting, and I can't believe I've never asked this of you before, but I obviously have a lot of background with an investment committee and how decisions are made and how two people can interpret the same data and come to different solutions and how you have to work around that. And as I mentioned in your bio, you're part of the investment research committee as well as the investment committee. So even thinking through, and you don't have to get into the specifics unless you want to on profitability momentum with it, but I would just be curious because I bet most people don't really spend that much time thinking about how their fund company's investment committee works. So maybe you could pull back the veil for us a little bit on that.
Yeah, and it's a open and robust discussion happens in the investment committee, and you also mentioned the investment research committee. Both of those committees are areas where this type of research gets vetted. And it kind of, when you think about those two differences, profitability and momentum, it goes back to some of the things that we talk about as were true at the start of the firm and are true today. And profitability fits into that sensible viewpoint of the world. It's basically a complement to security prices predicting the future. And how do you extract some of that information from security prices? Also, because it results in lower turnover, that means you have more flexibility, Peter. Because if you're doing 20% turnover in a given year and you spread it over the 250 trading days of the year, then you have to do a little bit of turnover every day, a few basis points of turnover every day. So you can be very flexible in how you implement that turnover. But if you have to do 100% turnover per year because you're pursuing something like momentum in a very aggressive fashion, then you can be a lot less flexible on how you implement that turnover. And optionality adds value, capture it for your clients. And if you don't have flexibility in how you turn a portfolio over, you're probably going to leave some money on the table. So those are the types of discussions around the data and the framework around the data that you'll have in the investment research committee, which is effectively a committee to discuss the research, the latest findings of our research team, the latest findings of academia, and say, well, what makes it above the grade? What makes it below the grade? What can we use that enhances what we do today? So it's new and improved on what we do today. and how might we use it? How can we use it to put ourselves in a position to actually improve the returns of a portfolio? And the example that I often use, Peter, is opportunity cost. And I use this one from Professor Murphy at the University of Chicago. And if the question is, if your kids are watching 6 hours of television a day, is that a good thing or a bad thing? And the answer is, well, I haven't given you enough information for you to tell me and answer the question. Because if their alternative is, Peter, you're going to be teaching them about investments and mathematics, and you're going to be reading your latest book to them, well, then it's probably a bad thing because the opportunity cost is pretty high. If, on the other hand, they're going to be out on the streets, getting into all sorts of trouble, then it's probably a great thing that they're watching 6 hours of television per day, because it will keep them from the alternative, which is a bad thing. And when you think about investing, the market is a pretty good place to be. And so profitability allows you to be much more market-like with respect to turnover, with respect to your sector weights, with respect to all these things that you would care about, so that if profitability premium turns out to be zero over the next 10 years, you've put yourself in a good position to end up with market-like returns. If momentum turns out to be zero over the next 10 years, you may not get those market-like returns. You may get something far less. And what we know is that the probability of any of these premiums being zero over the next 10 or 20 years is non-zero. That's a real probability. And so you always have to plan for the worst. You can't predict it, but you can plan for it. And we think that's an important aspect of how we take these pieces of information and actually implement them in real world portfolios.
About interest. Implement.
Hey, Peter, hang on a second. You're breaking up pretty terribly over there. You want to just restart that question?
I saw that I had interest. Give me 1 second here.
Yeah, sure.
I don't know if there's anything I can possibly close. Sure. Okay.
Yeah, let's just
think
retake
about
that question.
what I was even saying.
I don't think Gerard.
Okay, can you hear me okay now?
I can hear you okay now, Peter, but I couldn't hear anything in that question. Sorry.
Yeah, let's retake that question.
Well, it was a bad question anyway, so I'll make it better this time. That's okay. Ready for me? What's so interesting about what you just said, Gerard, there's just so much overlap in the thinking behind making a choice on the behalf of the end client. And really, again, the fact that there's so many layers of thoughtful research and decision-making before a client gets linked to their portfolio, which may not change that much year to year. And they think, well, what is everybody doing? All this happening behind the scenes. I always have personally found it fascinating to watch you and your team and your firm work through different ideas. So I always have the privilege to know you're constantly working, even though the ticker symbols may not change and, the core investment philosophy doesn't change. That's really a strength. But again, for the end client, it may not be so obvious how much work is being done behind the scenes. So I really appreciate you sharing that. I was hoping to pivot a little bit, given your role, you're leading one of the largest asset managers in the world, and you have a line of sight into both what investors are demanding as well as what is possible in the world of investing. So maybe you could share with us a little of where you think the future of the investing universe is going. How will it look different? And I don't know, 5 years, 10 years, 20 years, whatever makes sense, however well your crystal ball works, which I know is perpetually cloudy for us all.
It is perpetually cloudy. That's a good way to put it, Peter. And one thing that you know very well about Dimensional is that we work with financial professionals. And those financial professionals, we have a very open dialogue with them. And that helps us understand what the mom and pop investor needs to meet their investment goals. And so, that is a great position for us to be in. So we get feedback from folks like yourselves all the time, Peter, about what you guys are looking at and what you're hearing from your clients. And that feeds into how we develop and improve ourselves over time. And we have this kind of little saying here, the 3 C's, what we've heard a lot about from financial professionals like yourselves is that client circumstances are very complex. And that complexity requires a lot of customization in order to be able to deliver the best solution to that end investor that you can deliver. And with that customization, you want convenience. and they want convenience because everything else in their life has become more and more convenient over time. And so we've taken that on board. So there's a couple of areas that I think when I look forward at what we might see over the next 5-10 years that stick out to me. And one is just the need for asset managers like Dimensional to have a broad range of delivery mechanisms for their investment proposition. I think the great thing about Dimensional is that we have one investment proposition. It's implemented in lots of different ways. There's lots of nuance. And we do it across 45 different countries in equities and over 20 different countries in fixed income and thousands of bonds and thousands of stocks and all different types of asset categories. But it's based on those three principles that I mentioned at the beginning of talking about Dimensional. But we've heard from many financial professionals that they like mutual funds, they like ETFs, they like SMAs. And they want to learn the investment proposition once, but then let them choose their adventure on what works best for their clients because they know their clients best and their clients' circumstances best. So I think that's one thing that you'll probably see more of. You'll certainly see it from Dimensional. We've spent the past 2 or 3 years. We've been pandemic busy, as they say. We got very busy during the pandemic, bringing a full ETF offering to the table, and also a SMA offering, dropping our minimum from 20 million down to 500,000 for customized SMAs. And I think that's something that you're going to see plenty of. Other things that I think you'll see plenty of in the future is this kind of values-based investing gaining more prominence, because as you get new technologies, as you're able to customize more specifically and precisely to an individual, and you can do that very conveniently, I think that individuals who have a certain set of values, whether those are conservative or liberal or anything in between, those values can be expressed more cleanly for them inside their investment portfolios. And I think taxes probably come down to that customization as well. So that will be another area that I think will likely gain in prominence over the next 5 to 10 years, because technology is just enabling that point of difference where before the economies of scale of commingling assets far outweighed the benefits potentially of investing along to your individual values. But that trade-off has changed over the past number of years. So I think that it's likely that we'll see more of that. The other one that I'd say, and this is self-serving, Peter, but we've seen a lot of growth in systematic investing, and Plancorp has been along on that ride with us for many decades now, yourself included. And to put some numbers into context, we've seen, if you go back 10 years, and 10 years ago, and you looked at Morningstar and you looked at the strategic beta asset category. Now, that's not all of systematic investing. We're not index, for example. We go beyond indexing. We think that what we do is better than indexing. We think indexing leaves a lot of money on the table, and you can get a lot of the benefits of indexing, the low cost, the low turnover, transparency, with an active implementation that we do. So we're not indexing, but that gives you a proxy. It was about 180 billion 10 years ago. Today, it's about 1.7 trillion in systematic type strategies. If you look at fixed income today is about 20 billion strategic beta fixed income in the Morningstar definition. I think there's going to be a lot of growth in fixed income over the next decade that is systematic, because people are facing an ever more complex world. And there's those 500 plus interest rates that they have to deal with. The only way to deal with those in an informed fashion is in a systematic process. So I think you'll see, hopefully, more systematic fixed income. And we've enjoyed some of that over time. But there are some of the things, we can get into more of the specifics of values or goals-based and all those types of investing, but there are some of the ones at a broad level on strategy delivery. And I can talk a little bit about the research side, but that's strategy delivery. So let me pause there in case that elicits any thoughts on your end.
Well, I would love to dig into the ESG or sustainable investing or values-based, however you want to frame it. It's interesting. I remember you visiting the firm. We're ever so lucky every once in a while when you or other the great resources at Dimensional come and help us through discussions. And we were designing our ESG portfolio. And I remember I was listening to you talk about sustainability and making the case for its importance. And there was part of it from a world perspective as well as an investment perspective. And I think I told you, I was flabbergasted. I had never heard anybody describe it the way that you did. So I'm putting you on the spot by saying it was so amazing. And I know you probably can't replicate, you probably don't even remember what you said, but maybe, just maybe, if you could speak a little to the investment that you've made in sustainability research and sustainability products. I know that's in response to demand, but any sort of insights you can give there, because I do think that that is a place of growing interest among investors that we speak to.
Yeah, and thanks for that, Peter. I always enjoy my visits up to the office with you and the investment committee and all the staff there. Always a fun time. You know, when we think about sustainability, there's lots of values-based investing more broadly. I think there's lots of good things that we Dimensional think that we can bring to the table there, and those are our expertise in data, right? That's item number one. So we listen to our clients and to the financial professionals that we work with. We hear what they're saying, what their concerns are, and then we task ourselves with the job of, well, how do we get data that can help us be systematic in addressing that concern, do it in a well-diversified fashion, do it in a repeatable fashion, and do it in a fashion where you can demonstrate that you've did what you said you would do. And climate change was probably one of the ones that we dug into when we were talking about it probably a few years ago now. And that was, again, an issue that a number of clients had expressed concern and interest in. And this is over 10 years ago, 10 to 15 years ago, our sustainability strategies that focus kind of on the climate change and environmental have been around between 10 and 15 years now. And so we figured out, how do we get the data? How do we process the data? How do we clean the data? How do we link it to our overall investment universe? And then how do we come up with a solution that sacrifices as little diversification as possible, that doesn't meaningfully change size, value, profitability characteristics, and expresses those values that the investors have, such that they can then feel good about their investments, which maybe enables them to become a long-term investor, but also have a good investment outcome. So examples would be, like, if you look at those strategies and you look at the weighted average, so take stock by stock, greenhouse gas emission intensity, so how much emissions are they producing per unit of revenue, and you look at how much of a reduction can you get relative to that number for the market. And you can get 80+% reduction in weighted average greenhouse gas emission intensity in the way that we pursue sustainability in that particular strategy. So for those investors that care about climate change and so on, here's a way that you can feel good about your values and still have a good investment experience. The thing that I would say about those values and how we focus on it as well is that there are certain values that you might be able to link to external costs. So what do I mean by that? I mean, the argument that people often put forward for climate change is that you're enforcing an externality, that you're consuming something today, you're using up the environment today, so you're getting the benefit today, but future generations are going to pay for the benefit that you gain today. So that's kind of an externality, would fit into that area where markets work best when all costs and benefits are internalized. When certain costs are external, so you get the benefit but don't bear the cost, markets don't work as well. And that will be an example. And we've done a lot of work there. And there's others that are maybe more faith-based type values that may or may not have that same kind of economic context to it, but where you can still get very good data to help those folks that have those values have an investment experience that they're comfortable with, and where their investment dollars are going to the companies that they prefer those investment dollars to go to. So we've been doing that for quite a period of time, and we try to get better. We have multiple data sources, so we've spent a lot of money and effort on improving our data, whether it's on the E, the S, or the G over the past decade. And I think that we have a very compelling offering there.
And one of the things that you led off with when I asked you about the future of investing was customization through separately managed accounts, or SMAs. And you mentioned that you dropped your minimum, and I hope everyone heard, from 20 million down to 500,000. So a big change. And I think ESG goals one of the challenges with ESG investing when we are working with clients is that it means something different to everybody. And products have to make choices about how they're going to structure themselves and what they're going to emphasize or de-emphasize. But when you go into a custom portfolio, and people in the news might be reading about it more now as something called direct indexing, but that has been around for ages at this point. But this ability to layer on things that are important to you for the E, the S, or the G does introduce a new opportunity. And I think you all, like many others in the space, are addressing that. And one of the things that's interesting is, decades ago, you could only call up a broker and buy individual stocks. And then eventually you could call your broker and buy a diversified basket of stocks, still actively chosen, but a diversified basket. And then you're calling your broker and asking for asset allocation. And then there are advisors in the world, and then there are index funds, and then index funds are familiar, but then there are ETFs, and now there are SMAs becoming more to the public. I guess when I think of those developments and the role in which you're doing it, how do you think that continues to progress? Is that something that you feel like you can picture how it progresses?
I think that definitely will continue to progress, Peter. I think that over time, the investment offering available to the end investor is going to improve. And you highlighted some of the improvements that have happened, over the past number of decades. And that goes back to the customization. I think investors will be able to get customized strategies for their tax circumstances and for their own values more and more and more in the future. I think what will be tricky for investors is how to choose, and which is why financial professionals are an important part of the value chain in our view, which is, direct indexing. It's indexing, and indexing is fine. If you're going to hold the market, it's probably not too bad, but I think it leaves money on the table. And direct indexing is effectively indexing and kick out a few stocks that you don't like. What I think that we've done bringing to the table with our SMA Center is the ability to have that institutional quality asset management brought through improvements in technology to a very an account size that most folks can probably attain over their savings lifetime. And we'll probably be able to lower that minimum further and further as we get more operational efficiencies in the future. And so I think that's an important point of difference. But what I see for the future is that technology is going to enable financial advice and financial products to be delivered very cost effectively in a very tailored fashion, such that hopefully that will improve the investment outcome and people getting to their investment goals better than it has in the past. And I think that's a very bright future and a lot to look forward to, I think, for investors. Because if you look at the past, investors have done fantastically well. The fees they pay have either gone down dramatically, or they've gotten many, many more services for the same fees. That's a great outcome for the end investor, right? They've gotten better services for the same cost or lower. It's been a good outcome, I think, for investors.
Yeah, I think there's no question. There has never been a better time in history to be an investor of any size. With time, I know you are very busy. I want to make sure to be respectful of that. I have two questions I'd like to finish up with that I've been asking all my guests. And the first is pretty simple. It's, Gerard, how do you invest your own money?
So I work for a large asset manager, which means my human capital is driven by the success of this firm, but also what happens in the market. And so if you look at Dimensional's book of business, at about the 680 or 670 billion that we have under management, 120 or so is in fixed income. So we've had about 20% in fixed income, 80% in equities. So as a firm, you can think of it as a bit like an 80-20. But then it has its own idiosyncratic nature to it. So we'll call it all equity. And a lot of my human capital is tied up in that. Given that a lot of my human capital is tied up in that type of a firm, I'm probably overweight fixed income relative to the average investor. So I buy a lot of our fixed income strategies that do all the things that we talked about. They're flexible and they invest. But so I have my fixed income allocation, all investment grade generally, and we'll do a little bit of variation in duration and credit quality inside those strategies. Then my stocks, global in nature, all size categories, large caps down to micro caps, US and non-US developed and emerging markets. So I like diversification across my equities, and the same with my fixed income, kind of globally diversified basket. So I'm sure in quite a similar fashion to how many of your clients invest. I'm invested in all dimensional strategies, global equities, global fixed income, with probably a little bit more in fixed income than your average bear.
Well, I love that you mentioned the human capital part, because I myself, as a part owner of Plan Corp, my income is tied to the market. That asset on my balance sheet is tied to the market, and so certainly I have a very leveraged market exposure when you look at the overall balance sheet, as well when you pull in the income statement. And so I've written a post that I'll link to in the show notes, again, the longterminvestor.com. That's how I invest my money. And I talk a little bit about that, but I really appreciate you raising that, because I do think people often forget about that. They're overly focused on the investing and not thinking about the whole picture. One final question for you, Gerard, what does it mean to you to be a long-term investor?
So a long-term investor is somebody who can find some joy in the unknown, because investing is all about bearing uncertainty. And if there was no uncertainty, there would be no reward to be had. So if stocks were not uncertain, then you should not expect stocks to outperform T-bills. So it's that very uncertainty that makes people a little bit nervous that is actually what drives the reward to investing. And so as a long-term investor, and we've referenced this, your probability of success, and what I mean by success is getting positive market premiums, positive size, value, profitability, term, credit, duration, all of those things. The probabilities all go up the longer the horizon. But to stick with it over that long horizon, you have to be able to deal with, times when returns are better than expected and worse than expected. So when you're happy and you're sad. And so I think having a plan that allows you to deal with those times, know that there's uncertainty in the future. It will always be thus. But that's the exact thing that drives you towards getting those returns. And over the long pull, if you can stick with it, you'll probably be okay. If you save well, if you don't spend beyond your means, if you get a financial professional to work with, you'll probably be okay. And I think that investing is about getting you to your goals in such a way that you can get there more quickly than you otherwise would by not taking risks. So I think there's a bit about finding joy in the unknown that is an important quality of being a long-term investor.
That is wonderful, Gerard. Again, thank you so much for joining me today. And to all the listeners, if you want to see this, you can always find the interviews on YouTube, subscribe to my channel, leave a comment in any podcast platform. I love reading those. Those are always very helpful. And as a reminder, you can always find show notes, free resources, and a place to submit questions to me at the longterminvestor.com. Again, Gerard, thank you so much for being here with me.
Thanks, Peter. I had a blast, and always good to catch up with you.
Talk soon.